Good afternoon, everyone. This is Tim McCusker, Chief Investment Officer from NEPC. I'm excited to welcome all of you to our first CIO Conversations, the first in a series of webinars that we're hosting to allow our clients to hear from some of the brightest minds in the investment industry. I'm delighted today to be joined by Jeffrey Gundlach, Founder and Chief Executive Officer of DoubleLine. Jeffrey is going to take us through his worldview, everything that he sees going on from an economic perspective and from a markets perspective. I'll jump in with a few questions here and there, but mostly I'm just going to let Jeffrey roll because we're really excited to have him here today. Jeffrey will go for about 45 minutes or so. We'll leave some time for questions at the end. So if you do have questions, feel free in that panel you have on the side to type in a question, and we'll try to get to as many as we can as the time wraps up. So Jeffrey, thank you for joining us today. We're really excited to have you.
Thank you, Tim. It's good to be here and join you today.
Thank you. And I'd love to just hear first how you personally and how DoubleLine as an organization have adjusted to working from home, how you made that transition, and how you're handling that. Less about markets, but more just about interacting with your colleagues. How's that going?
Yeah, well, it's going remarkably well. We used to do like a day of BCP type testing where half the firm would kind of pretend to work from home. We do it every so often. And then when we heard that it was really basically when the NBA shut down, I think that was on March 11th or something, we started talking about seriously restricting visitors to the office and any kind of travel. And as we were talking about in our executive committee, it just seemed to me where it was very obvious to me where this conversation was headed. And I said, I don't understand why we don't leave right now and start working from home tomorrow. And that's what we did. And it was really surprising how well this technology worked. We used this Teams technology, and it gets kind of repetitious. We have an executive committee meeting every single day. That's the first meeting, and then we have an investment team meeting every single day. And in that way, the days just are very patterned, and they kind of blend together. But complicating the whole situation of work from home was the market was a total disaster in the middle of March, and the bond market in particular, and we'll see some slides on this, but the bond market was the sloppiest and the most illiquid that I've ever seen in my career by a lot, and that's definitely surpassed the 2009 turmoil in March of 2009, which was really the bottom of the bond market. There was at least a bid for anything in 2009. There were many parts of the bond market that in the middle part of March, literally, you could not sell. There was literally, you would put out a list to a dealer looking for a bid on a certain set of bonds, and there were no responses. So I think that's what led to the Fed kind of going full bore, realizing that this thing was going to spiral down to zero unless there was some sort of a facility. So, but we're doing well. Everybody's, we had one employee that we know of. I think we had two that had tested positive and had symptoms and stuff. But I actually think a lot of people were asymptomatic and have gotten the virus. I've heard that 25% of the tests in New York City were positive, and they did a lot of testing there. So that's for antibodies. So it shows just how contagious the thing really was.
And before we get into your worldview, being located in Los Angeles, what are your thoughts on when things start to open up for you guys? What do you predict when you'll be back in the office?
Well, we're going to be tardy, I think, relative to the majority of the country. I think California is being led really by the governor, and I think in San Francisco they've announced that they're on lockdown until June 1st now. And the way this pattern has gone is Los Angeles has pretty much followed the Northern California movements. So my guess is we're talking June 1st at the earliest, which seems far away, but we've already gone through 6 weeks of this thing.
Right. Well, thanks for sharing that. I'll step out of your way for a little bit here and let you take us through how you see the
Yeah.
world from your
Well,
perspective.
right, sure. On the screen is this. There's these two sinks, and this is actually an artwork by a guy named Robert Gober. It's from the Whitney Museum collection. It was made in 1985, and they're not actual sinks. They're actually made of plaster, wood, and wire and steel and enamel. But the meaning, these are called ascending sinks. And the reason that I thought of this is I have two sinks. I have a pretty big kitchen. I'm actually in the kitchen right now. I have two sinks, and one of them I never ever used. It was there's one that's in the island near the stove, and then there's this other one that's on the other side of the kitchen. And the one on the island near the stove started leaking like 2 days before we started working from home. And I called a plumber, and they'd order a part. And so I didn't want to use that sink because it was very hard to get to stop from leaking really badly. So I started using the other sink. And since we're in this you got to wash your hands all the time mode for trying to get not get the virus, I started using this other sink, and I was washing my hands a lot, and I started to realize that I actually like the other sink better, at least for washing my hands. I mean, it's got a view that's way better. It's not just a view of the wall. It's got a view outside, and I can see the TV, one of the TVs from it. I started to see, you know what? I'll probably start using this sink. And what got me thinking, what that triggered in my mind, that I think a lot of people are starting to appreciate, that they're not going to go back to their old habits, at least not fully, and that things are really changing here. I mean, these things were done by Gober in 1985. He started working on them in 1984, which was actually the darkest period of the AIDS epidemic. And there was in the cold air of clinical hygiene. And these sinks are sort of anthropomorphic. I mean, where the taps would go is where the kind of eyes would be, and they have sort of an animate but inanimate sort of a quality to them. And an art critic John Russell in, I think, New York Magazine noted that the minimal forms with maximum content, as contrasted with what was going on in the AIDS epidemic. But it triggered me to think about what the Fed has done, the government has done here. They basically have split the economy into two sinks, so two different regions. Region number one is if you're blessed to be part of the Fed's buying program, then you've gotten a lot of credit extended to you, and the junk bond market and the corporate bond market have been massive beneficiaries of the Fed's balance sheet expansion and other efforts with these facilities, because the corporate bond market was crashing in the middle of March. And then they came out and said, we don't even care about the Federal Reserve Act of 1913, which makes it illegal for us to buy corporate bonds. This is desperate times, calling for desperate measures. And so they started these facilities where they're now in direct violation of the law. And I was talking to somebody who was at the Fed during the 08-09 period, and they told me that there was serious discussion about the Fed buying corporate bonds in the global financial crisis, but they decided not to because it was just a bridge too far. It's just blatantly illegal. But that's where we are today. We're in totally uncharted territory with the Fed. We'll talk about that in a little bit. But let me move on. Just a quote from Lenin. You don't see a lot of quotes about Vladimir Lenin financial presentation, but he says there are decades when nothing happens, and there are weeks when decades happen. Take a look at GDP forecasts for the world is on the screen right now. And what they do is they take the consensus of the economists, basically I think mostly domestic economists, but there might be some other World Bank people and stuff like that in the survey group. But every year they start asking, well before the year begins, what do you think world GDP real is going to be for the upcoming couple of years from now? So every year it was kind of the same. At least the scale was much smaller, and they started out kind of downgrading. Most years in the middle part of the 2010s, they had to downgrade world economic growth, and then something different happened in 2017 into 2018. They actually ended up upgrading. So the world economy was really at its peak, at its apogee, January of 2018, which was the top of the global stock market. And I said I thought that was going to be the case at the time. Every stock market, if you take the United States out, the world stock market peaked January 26, 2018, amidst the synchronized global expansion narrative, which had some real data points that underpinned that narrative. Now you see what happened. Now we're down to -1.5% world GDP from pre-virus, up at around 3 or 3.25%. So a huge hit to global GDP. You can see that same type of decades happen in a few weeks theme and the PMI surveys. These are mostly services on the screen. I think they're all services, but we say that they just have collapsed to levels never seen before. We used to think that if you were in the mid 40s, you were a really depressed PMI. If you're above 50, you're expanding. If you're below 50, you're in contraction. So not surprisingly, we've seen the most horrific fall off of all time. I don't think this can go negative, but we also didn't used to think the price of crude oil could go negative. So a lot of strange things happen. I'm not sure if this would bottom out at 0 or not, but some of these are getting darn close to absolute 0 types of readings. Here's a quote from Ben Bernanke, which shows you how kind of clued out he is. He said March 25th, so this is full into lockdown mode. This is a very different animal than the Great Depression. This is more like a snowstorm, closer to a snowstorm or a natural disaster. Well, I grew up in Buffalo, New York, and I could tell you this is nothing, and it wasn't March 25th. It was nothing like a snowstorm. I lived through the blizzard of '77 when I was in high school. It was the biggest blizzard in the history of the city of Buffalo, which is saying a lot, and we were shut down for basically a week. So Ben doesn't really know the magnitude of things. So one of the things that's going to happen here is clearly global trade is going to get upset, because we see on the screen it's trade balance by country, and China has this massive trade balance. And one thing that we've all learned is that maybe just-in-time inventory and maybe relying on China for, I don't know, virus information, and maybe relying on China for inputs into our pharmaceutical industry isn't the greatest idea, and maybe we need to be a little bit more self-reliant. I think that's a major theme that's going to be coming out of the other side of this thing. But look at the right-hand side. There's the United States, which clearly is the most out-of-balance trade in the world. Now, of course, we're the biggest economy, so you want to look at this maybe as a percentage of GDP. But the United States has a lot to gain from in terms of bringing things home, becoming more self-reliant. And there's a lot of ways that we can do it. Talking about the United States, here's the GDP forecast, that same thing that I showed for global growth falling off a cliff. The United States was a little bit more volatile, as you would expect. Any single country would be more volatile than the world economy generally. But it was the same pattern in the early part of the 2010s, in the middle part, and also you see 2018 was an upgrade year. That's that lime-colored line off to the upper right. And then we see now that the guess for, and this was as of March 16th, so this data gets lagged. Right now the guess seems to be -3.5 for 2020 in terms of real GDP. That seems really high to me. I had to laugh when I did a presentation a month ago. The economists in the United States, the major investment banks, were all guessing that 2020 real GDP in the United States would be like -0.3, -0.6. But now we know that the actual non-annualized GDP for the present period, the present quarter, is probably going to be something like -12 or -15, which takes you to -40 or -50 on an annualized basis, depending which number it is. We know it's going to be a really, really bad number. And then, it should get better depending upon how effective the so-called opening up of the economy becomes. Now, this is an unbelievable chart. We've been using this for years to try to get a sense of, are we in a recession or not? What we've done here is we've plotted out the dark blue line, which is the 4-week moving average of the initial jobless claims that come out every Thursday. We use a 4-week moving average because it's just so volatile that week by week it gets really noisy. So we smooth it out a little. And then we compare it to the red line, which is the 5-year moving average of initial unemployment claims. And look at the red shaded vertical bars. Those are recession periods officially. And you'll notice that this is a very good indicator historically that you get a crossover. The blue line crosses above the moving average red line, really right at the front edge of the recessions. And this goes all the way back to 1974. So it's a really good indicator. And as we shot through with that 1 week of unemployment claims that shocked everybody when it came out at 5 some odd million, And then we've had a couple of 6 million weeks, and now we've got another 5 million. So we're up to the last 5 weeks is now something like 26.8 million filings for unemployment claims. Not all of those will result in unemployment benefits. Sometimes they get rejected, sometimes the people aren't eligible. But it's amazing how out of context the current situation is. This is a log normal scale, which just makes it even that more fascinating. So here's something to think about. I think what most people fail to understand, and I was trying to talk about this and get people to listen. I was talking about trying to get people to listen last summer, that the economy was not in good shape in spite of what you hear from the permeable economic forecasting services or from President Trump. The economy was not in good shape in 2019. The growth in nominal GDP was significantly less than the growth in the national debt in 2019. So if we hadn't gunned the national debt, there would have been negative nominal, let alone real, nominal GDP in 2019 if we had kept national debt stable. And also what's on the screen now is there's an index called the JOLTS index, Jobs Opening Index, and it was really looking weak in 2019 already. So things were not really all that great. In fact, the only thing that kept the economy going in 2019 was consumption was pretty strong, and consumption was fueled by people borrowing a lot of money. There was a lot of cash out refinancing in the housing market. There's a lot of debt everywhere. And consumption was 90% of nominal GDP in 2019. It's usually about 2/3 or 70% is the standard, but it was 90%. The only thing that was carrying was debt and the consumer consumption, and there was evidence, I think, that the consumption was getting pretty far along into the end game. And I think that people are going to be shocked into habitual changes, just like I'm going to use my other sink, when they start to realize that the economic shock that they've experienced was really frightening. For the last year, there's been numerous guests in financial media on TV that have pointed out there are surveys that show that a very large number of Americans don't have any savings at all, no rainy day fund, not even, they can't even absorb a couple $100 unexpected expense, like a car breaks down or something. And what this has revealed is these people have been scared to death. And there's a lot of anxiety. I'm reading a lot of surveys that talk about how people are getting near their wits' end with anxiety and loneliness and, kind of going stir crazy and all this stuff. And I think people are going to start thinking about their financial security a little bit more soberly than they were. I've commented in multiple webcasts in recent years that I can't get over. I employ a lot of people, and some of them, quite a few of them, are under the age of 35. And it's amazing to me the kind of lavish vacations they go on, the way they spend money. I mean, it's really remarkable how they don't seem to have any sense of the value of saving. I was talking to a friend of mine just recently who said that she had a child fairly recently, and when the child turned 6 months old, when the child was 6 months old, they received a credit card application in the mail for the 6-month-old, which just shows you how far we've gone towards a borrow your way to a feeling of wealth. You're not really wealthy. We talk about how the American dream is owning your own home. That's what the government has sold everybody, and certainly the housing industry has sold everybody. But people don't really own their home. They live in it. They're sort of renting it because they're constantly rolling over their mortgage. I saw a shocking statistic that about half of retirees have mortgage debt, which seems completely inappropriate from a financial planning point of view.
Hey,
this is a very strange table.
Jeffrey, just a quick follow-up there. As you talk about the idea of U.S. citizens maybe being gun shy now and saving more, can you contrast that with, I know you've talked about this as well, the idea of the safety net that's been established here, the extra safety net, unemployment benefits, improved unemployment benefits. Some folks are even doing better than they were when they were employed. Does the reality set in for folks?
Well, a lot of people are doing better. It's not just a few are doing better watching Netflix at home, receiving unemployment benefits than they were, doing the 9-to-5 grind at work 2 months ago. And the reason is that they've put in the sweetener into the unemployment benefit of $600 a month. So that actually creates an increase in money that's coming your way. I've seen different statistics, between 25 and 50% of all the unemployed people are getting more money now than when they have a job. And the problem with that, of course, is it puts a real brake on so-called reopening the economy. Because how are you going to hire these people back? This just seems like one of the main thrusts of all these programs is to get people not fired. But if they've already fired, and to unfire them with these PPP so-called loans, which are just giveaways, that you have to hire them back. Well, they're not going to come back unless you pay them more than what they're getting for not working in at least a significant fraction of the cases. So I think that unfortunately, we don't seem to be at peak bailout yet at all. I heard Joe Biden emerge from his basement a few days ago and announce that we need a vastly bigger bailout. And he said, to use his exact words, a hell of a lot more than $2 trillion more. So the people are going to be really affected by this radical fiscal policy that we're running. And I just think that finally we have gotten to the stage where we can't pretend anymore. We can't pretend that we're going to pay our unfunded liabilities. We can't really pretend that we're going to pay back $10 trillion of deficit that we're going to run probably this year. Now, if we put it on the Fed's balance sheet, but the Fed, I don't think, is even pretending that they can unwind. They tried that. Let's talk about the Fed in a slide here. But this is prescient. Bullard from the St. Louis Fed last September said this quote: "Something's going on, and that's causing, I think, a total rethink of central banking and all our cherished notions about what we think we're doing." And here's the key point: we just have to stop thinking that next year things are going to be normal, because the Fed cannot unwind this balance sheet. Here's the Fed's balance sheet in blue, and I put on that repo facility, which was the canary in the coal mine. That's down there in the orange line, where there was nothing going on with the Fed holding repo agreements. But then September 17th of last year, they couldn't float overnight money at anything resembling the Fed funds rate. It exploded higher. There wasn't any demand, and the Fed started to realize that even that little decrease in the aggregated blue line, which was so-called quantitative tightening, was enough to completely short circuit the liquidity markets in the treasury market, even the overnight market, which should be the easiest one to take care of. They didn't call it QE. They just didn't want to admit that they were doing QE again. They needed the economic downturn to finally stop pretending. And now we see the blue line is up at, I don't know, 6-point-something trillion. I can't see the scale, but with the slope on this thing, it's pretty clear that this thing is headed to $10 trillion. In terms of the Fed's balance sheet. So there's no way, if they couldn't unwind $4.5 trillion and they had to stop at 3.8 trillion because the economy was reacting poorly to the quantitative tightening, obviously they're not going to be able to unwind 10 trillion in any sort of, in any sort of way. I really wish that Powell and Mnuchin would write a joint op-ed piece, put it in the Financial Times or something, and tell us what the end game is. I want to know, what is the end game of all of this? Because you can't pay it back and you can't unwind the balance sheet. And now we're giving money to people. There's a clamor to give people thousands of dollars per month, and forget about qualification tests. Just goes to everybody who's over 18. And so you might say, well, Japan did it, so what's the big deal? And this is Japan in blue. This is the balance sheet of the BOJ as a percentage of Japanese GDP, and then we've got the red, which is the Fed, and this hasn't been updated. This is through March 31st, so the line's vastly higher now than it was. But what I say to people is, yes, Japan went to 108%, balance sheet as a percentage of GDP, and they have not had, you know, a really big economic problem. But let's not call it a roaring success, because over that time period, since about 2011, where Japan was about where we are today, they started gunning their balance sheet, their real GDP over that period, if we don't include the hit that they're taking now. So prior to the present virus-related massive economic hit, Japan has had something around 1% of GDP. That's the payoff for this massive balance sheet increase. So it's not like increasing the balance sheet has any precedent of leading to economic prosperity. Here's important. This was an important thing. I used this in a webcast pre-virus, and we used that horizontal black line. The top panel is copper, which has been signaling really weak economic activity ever since the middle part of 2018. So copper was obviously giving a telltale that the economy wasn't that great. See, the problem here isn't the virus. That's what most people don't understand. The problem is the economy was completely unhealthy all through 2019 anyway. We just needed a catalyst of economic downturn. It didn't have to be one that was this monumental, but it was going to reveal a lot of problems. Then we see we were pointing out in that webcast pre-virus that these horizontal lines were really major levels that would, if they got breached, would probably lead to a waterfall decline. We certainly saw that a little bit in copper, but more so in West Texas. This is the first contract, so this reflects that negative oil price that happened last week. That was initially blamed by the talking heads on TV on excessive supply, but that's not why it went to -40. It went to -40 because the speculative commodity markets, gold and I would say gold and oil are the two most commodity markets most wrapped up in speculation. They're completely unhealthy because the people who are long generally aren't producers, some of them, many of them, and the people, people who are short, rather, the commodity, they're not really producers. They're just speculators that want to bet on the short price going down. And then the other side, they're long, they can't take delivery. They're not real oil users. They're just speculators. We saw that particularly in the USO ETF, where all they're doing is buying paper oil, and then they're going to deliver to me, and now you're doomed. And that's why oil went to -40, and we're seeing the June contract now, which closes out in 3 weeks or so. That is at $12 now. So it looks like we might go negative again. I just don't understand why they don't shut down in the aftermath of that WTI experience. I just can't understand why they don't shut these ETFs down. It's just like those volatility short ETFs that blew up couple years ago when that one went down 97% in a day. These things are dangerous and they shouldn't be allowed. So we're going to see a lot of regulation, I think, of the commodity markets. I think we're going to see changes in the ETF markets because we've seen too many cases of dysfunction when something happens that these ETFs are designed to function during times of stress and they can't. Here's the price of gold. Now this is spot gold price. So this doesn't track the futures as much. And we see we've had a huge breakout back in 2018 above 12. Once it got below 1200, it was a pretty good buy. And we talked about that at the time. And then we've had this huge gold rally. But I think there could be a problem in gold that's the opposite of the problem that happened in oil. And that is that what if all the paper owners, like the GLD, maybe the GLD is just buying gold futures. What happens if the owners of GLD on the long side decide that they want to take delivery of the gold? That's actually pretty easy to do. To deliver to a gold futures contract, it's a $100 bullion bar, and you can put quite a few of those in your sock drawer. So you can store the gold, but you can't store the oil. So what would happen is you might see a massive run on physical gold because the people, if they say deliver it to me, the people on the other side of the contract are going to fail. That could mean that GLD doesn't perform well. It could mean that GLD tremendously kind of fails and may need to bail out from the exchange because these contracts cannot be defaulted on. The exchange has to make them good. And so physical gold could really see a dislocation, and that might lead finally to a further realization that these ETFs aren't all that healthy. Just to flesh it out, here's the gold miners. It's amazing. Let's just go back. Gold up back near the high. Gold miners way down below 50% of where they were. So gold miners are notoriously badly managed. Maybe people think they've learned their lesson, but I don't know. I think gold has made its move for now. I think it's up an awful lot, and I think the fact that the miners haven't corroborated that is further evidence. This is the price. This is the red line is the S&P 500. This crash of March doesn't look like much when you put it on a log normal scale and take it back to the beginning, near the beginning of the bull market. But what we see is we've had a pretty big drawdown on a log normal scale. And interestingly, though, the S&P 500 priced in gold has been in a bear market since 2000. That's this gray shaded area. If instead of pricing the S&P 500 in dollars using the fiat currency, you actually price it in terms of the spot price of gold, the S&P 500 is actually down 50% plus since 2000. So is the S&P 500 really that strong? In nominal dollar terms, absolutely. It was very strong. In terms of a non-fiat currency like gold, actually the stock market's been in a bear market for 20 years. Now let's take a look at the pattern that we're seeing. This is just kind of a thought experiment. What we've got here is the orange line is our present experience, and then we're comparing it to 1929 in blue, 2000 in green, and the pinkish kind of line is 07. And we've seen, unfortunately, a decline that looks a heck of a lot like 1929. Now, the rebound is greatly bigger than 1929 already, but hey, the decline was faster too. And we live in a sped up world with our communications today versus 1929 and all of our terminals and all that stuff. So one of the reasons actually the 1929 experience was drawn out a little more is they actually had to close the stock market, not out of fear, although that was probably part of it. They closed it because they couldn't process the trades. There were too many, and there wasn't enough hours between the close and the open to process the trades. Then we take a look at 2007, and then we see 2000. We've had about the same magnitude decline as kind of the big leg down of 2000. And it looks a lot like the magnitude of getting close to the magnitude of 2007. Just to put it in another context, here we are comparing the S&P now versus the NASDAQ in 2000. So the S&P now this year is orange, and then the NASDAQ is blue from the 2000.com bust, and the Nikkei in 1989 is in the pinky line, and it looks a lot like the Nikkei, doesn't it? And it looks a little bit more severe, right? It looks like the NASDAQ, I should say. It looks more like the blue line. It's more severe than the Nikkei decline. But look what happened after the recovery in the NASDAQ back in 2000. It actually went on a much bigger decline. Unfortunately, I think that we have to factor in that as a highly plausible, not simply plausible, but highly plausible outcome in the future here. That you get crashes like this, and I know that at first on the rebound, people are saying we're going to get a retest, and then it's an all clear signal when the low holds. Well, true to form, Mr. Market confounded all of the so-called experts and did not retest quickly the low of March 23rd. Instead, we went on this huge snapback rally, which does look a lot like the NASDAQ snapback in 2000. And now the narrative has shifted to, well, maybe we should have known we weren't going to get that retest because it was just too broadly held consensus opinion. So maybe the low's in because the Fed is here. That's dangerous. I don't think the Fed can bootstrap the economy. You know, you can't. That's another thing of the two sinks. We've had the first sink of the market price. That's into March 23rd, and now we've grabbed our bootstraps and we've lifted ourselves up thanks to the Fed. And we're now hovering 6 inches above the ground, and we think that we can levitate ourselves with our bootstraps. But I guess the tale of two sinks is I expect another sink. And so the narrative was wrong. We get a quick retest that we give an all clear. Now the narrative that the bottom is in, we're not going to get near it, I think is wrong. The only thing that's left is we take out the low. I think that's the one that is the most plausible. This is fascinating. It kind of shows the problems with negative interest rates. The pinky line is the bank sector of Tokyo Stock Exchange, the Topix Banks Index. And we see that it is down from 1995. It's down 86%. Now, you'll notice that the blue line, which is the United States KBW Bank Index, and the orange line, that's the Euro Stoxx Bank Index, you'll notice that they acted very differently into the global financial crisis. Japan was at negative interest rates, so they were crushing their banking system, and the banking index did nothing but fall in Japan, while there was a roaring market of a 350% return in the bank indices, the United States and Europe. And then the global financial crisis came, and the US and European banking sectors tanked exactly the same amount in exactly the same time frame. And then after the global financial crisis, starting in 2011, we see that the US bank index, the blue line, had a massive recovery all the way back to a beautiful double top equal to the end of the year 2006 peak. Look what happened to the orange line, which is Europe. All it did was fall since 2011. And now it's down 52% from 1995. So it's had a massive decline since 2011. Why? Negative interest rates. Negative interest rates are fatal to a region's financial system in which those negative interest rates reside. You'll notice the United States made it all the way back, and now that we're back down to zero and doing, endless quantitative easing and deficit spending, we see that the banks have kind of collapsed. Now people are talking about negative interest rates in the United States. It would be a total disaster. If you want to see the United States stock market crash, then you go to negative interest rates, because you will destroy the entire global banking system. It's one thing to have little Japan negative, and even the Eurozone, which is a little bit more consequential negative. If you take the biggest economy in the world, and by far the biggest financial system in the world, and really the caretaker of the global financial system, and you go negative, you will destroy capital on a scale that the system cannot tolerate. And so I deeply believe that Jay Powell is right. I give him a lot of credit, which are words I don't speak very often, for understanding seemingly that negative interest rates are the worst idea possible. So zero's bad enough for the banks. We see that we tanked back down pretty nicely, but going negative would be a real killer. Obviously, what was driving the stock market, and why one of the main reasons why the United States stock market was crushed the rest of the world from January of 2018 into the top in February of 2020 was buybacks. And the Fed is on the hook for this, because they helped to have policies that motivated buybacks. And now we see the backlash that is understandable. I think everybody should be frustrated that significant airline carriers spent virtually all their free cash flow on buying back their stock. Over 90% of their free cash flow, bought back $45.5 billion of stock in recent years, and now have received a bailout of an even bigger magnitude from the federal government. In essence, what we've done is we've motivated the airline industry to leverage up imprudently, buy back $45.5 billion worth of stock, and then when trouble came, just sell it to the Treasury Department at a 25+% profit, because they're getting a $58 billion bailout on $45.5 billion of buybacks. Well, buybacks, I think, may become illegal unless a company meets certain, qualifying financial metrics, like, profitability, like debt to equity, and all this other stuff. So that will be a good development, because the buybacks are one of the reasons why we're in such an unhealthy position going into this economic downturn. This is another reason why I say the economy wasn't in very good shape. The red shaded area is the budget deficit. It's not even the national debt growth. It understates the actual problem. But I'm using the budget deficit, the red shaded area, and it's plotted inverted as a percentage of GDP. So when the red shaded area gets bigger, it means that you're going deeper into debt. The deficit's growing as a percentage of GDP, and typically the red shaded bars are recessions. Not surprisingly, you go into a big deficit as a percent of GDP in response to a recession. Taxes go down, unemployment benefits and the like go up, And so you have a huge increase in the deficit. Well, the deficit was already pre-crisis at levels that characterized the depths of recessions in the 80s and 90s. And the dotted line is the unemployment rate. And here we were at very, very low unemployment rate, which historically has been the nadir of the budget deficit because you're being at least somewhat responsible fiscally, but we didn't do that this time. So I got the red arrow on there. We're already way over 10% of GDP in the budget deficit. We're already at 3 trillion for the year. So we're already at 15% of GDP. And that doesn't even count the national debt, which is now rounds up to $25 trillion, which is well over 100% on national debt basis. That's a cumulative number. That's not a year by year number, but it's greater than GDP by a lot. The dollar has held up. It's been very volatile. The red line is the Dixie index, which is heavily euro dominated. I think the dollar has ended its bull run. I think it actually ended January of 2017. I said so at the time. You'll notice at the bottom is the momentum of the Dixie index. We've revisited nearly the January 2017 high, but momentum keeps kind of flagging. And there's a very large correlation between the direction of deficits, twin deficits, trade and fiscal. It leads the dollar index by about 2 years. And we know what this red line is doing. It's not the trade deficit's not the problem. Trade deficit's shrinking now, thanks to the shut off of global trade. And the US obviously is the biggest deficit trader. So we have the most deficit shrinkage of anybody, thanks to the slowdown in economic growth. But the budget deficit has completely exploded. And so this red line is now down, way down, that would suggest a Dixie index well below 80. And I think that when this shakes out, you're going to find that the U.S. is the worst performing stock market because it's was the most overvalued. And this has been a case for going back to 1985. Japan was the world beater in the late 80s. Their stock market was by far the strongest in the world. Then we had a recession in the early 90s. Japan was the worst performing stock market, and it now 30 years later isn't even close to where it was in 1989, a whole generation and a half later. Then you had the Eurozone with the enthusiasm about the euro. The euro was the top performing stock market in the late 90s. And then when the dot-com bust came, they were the worst performing stock market, and they haven't made it back since. And then you had, going into the global financial crisis, China was was ascending, and we had a very weak dollar, and that led to emerging markets were the #1 performing stock market segment in the world. And then the global financial crisis came, and they were the worst performing area, and they haven't made it back since. They come a little closer than Europe and Japan, but they haven't made it back since. Well, what characterized going into 2020? It's the US was killing everybody, and the S&P 500 was outperforming other regions for the last 10 years by a fully 100% or more. Well, I think that the pattern's going to stay the same. I think that the US is going to get kneecapped. It already has, so is the rest of the world. And for the last month, the US has bounced back much more than the rest of the world, but I don't think that that will maintain if we go back to another flush down, which I think is plausible. Here's the yield curve. We got a whole bunch of yield curves on here. 2s, 10s is the one people talk about. That's the blue line. I'm kind of old school. I like looking at kind of 2 years to 30 years, but it doesn't matter. The point here is that the yield curve has been steepening. That did not give a recession is on hold signal. Far from it. This type of yield curve action happens every time when a recession is coming, but the Fed could very well control the yield curve. Their quantitative easing, they've said they're on unlimited. They can set interest rates anywhere they want. The United States did that from 1945 into 1950s to make the war debt manageable. That could happen, but the yield curve left to its own devices, which is a big if. The yield curve would steepen, short rates would be rising like crazy. The long-term bond yield right now would probably be at 6% if it weren't for the Fed doing all the quantitative easing and yield curve control. So I don't know what the Fed's tolerance is for higher interest rates. It seems like they like the long bond being pegged, something in the low ones. So, but the market, with all of this issuance, unless the Fed just continues to gun its balance sheet at a rate of $10 trillion a year, rates would be going up. So we had a new low in the 10-year yield down at 65 basis points. The actual low intraday was 31 basis points, but these are closing yields. So the red line is United States 10-year, never really got below 50 basis points, and it sits at 60. It seems like it's pegged at 65 basis points or so. And then you have the German 10-year. I think you don't have to worry about higher interest rates until such time as that German yield goes to negative 18 or higher. So if it goes to negative 15 or negative 8, it'll take out that horizontal line, and the US, if US simultaneously takes out its horizontal line, which were basically created at the July 2016 lows, I think you would have to be worried about higher interest rates or be on watch for the Fed to get worried about it. I think it would be fairly easy for the 10-year to make it to 130 or so without getting too much consternation out of the market or the Fed. If we go above the horizontal line for both Germany and United States, I think there's going to be a little bit of a panic mode, and maybe we get yield curve control. One thing that I like to just do a reality check on where the 10-year yield is. We've been following the copper gold ratio out of the commodity markets for years, and the red line is the 10-year yield, and the blue line is the ratio of the price of copper to the price of gold. And you can just see how beautifully it's worked in terms of giving guidance on appropriate rate for the 10-year, really for most of the time of the last 5 years, but in particular over the last year, it's been absolutely perfect. And what the copper gold ratio is saying today is, fascinatingly, is that yields are appropriate relative to the pricing in commodity markets. The reason copper gold works is copper is an inflationary economic growth story when it's strong, and gold is a flight to quality asset and a deflationary sort of story when it's sold. So if you compare those relationships, if you think about it logically, it ties in to kind of what the price of money should be, because we're talking about economic growth and inflation fears. A lot of talk about how mortgage rates are really low, and they are, but they're not that low in the context of the last 9 months. In spite of the fact we've had a big drop in interest rates, we see that we're basically except for the big spike in March, we're actually near the high of the last 9 months in mortgage rates. That's because banks are overwhelmed, and there's a lot of credit tightening going on. There's been announcements made by JP Morgan, for example, that they're not going to do any loans unless you have a credit score of 700 and put down 20%. This could be a problem because that shuts off credit again, and the average down payment was 10% prior to the crisis. So if you're going to require 20%, you just made houses 100% more expensive to the borrower who is doing the down payment. It was 10, now it's 20. They can only afford half the house. So that's kind of a deflationary thing too. I'm almost finished here. Here's 30-year yields. So we see the low. This is really easy to remember. The low was 1.00. That was the low in the 30-year. So those permeable en bond economists that were looking for 1%, they nailed it, although it did go to 71 basis points intraday. This just shows you how bad the corporate bond market was. The total return of the corporate bond market on a rolling 1 month. So you can see that it was the worst this is investment grade and high yield combined. It was the worst return. I mean, not combined. The blue is at the top is investment grade. The red at the bottom is high yield. You'll notice that it was basically as bad in terms of 1 month worst price return as the global financial crisis, slightly worse in investment grade and almost identical in below investment grade. And look at the snapback. So we see that the investment grade corporate bond market has basically been repriced back to pre-virus levels by the Fed. But the problem is there are going to be defaults. So who owns the defaults? It's going to be a really interesting question, because these corporate bonds are wickedly overvalued relative to their default fundamentals right now, because they're priced as if there was no economic downturn. The prices are the same as pre-downturn. High yield has not fully recovered, but the defaults in the energy patch have started up already. and we've started to see a lot of downgrades of some major companies that should have been downgraded before the virus showed up, but the rating agencies were slow on the trigger, but now they're going to have to make up for that to save their reputation. And we've already started to see en masse downgradings from big companies, Ford, Macy's, Occidental Petroleum, and the like. One thing that was fascinating going into this year was the extra yield you got by buying BB corporates rather than BBB corporate bonds. We're just using index data here, was about the lowest in history. And I talked about this in my January webcast, Just Markets, and I said my best trade for the year is don't own BB corporates. I don't like BBB corporates either, but certainly don't own BB corporates. And you see how that spread is blown out from about 50 basis points to 300 basis points. So massive underperformance of BBBs. I kind of think one of the reasons that the spread was so narrow in January was that investors knew that the BBB market wasn't really BBB. It was kind of sort of BB anyway, because there were so many BBB corporates that should have been downgraded and weren't. Here's the turmoil in the muni market, where the Fed showed up and is now supporting the muni market, which is also illegal. One of the big questions that we're going to face in the months ahead is, will the states be allowed to default, rather declare bankruptcy, which is illegal per the US Constitution. So we'll see if we're now going to start violating the Constitution. We've already started to nibble away, but to wholesale reject a major tenet of the United States Constitution that is in black and white and in plain English, that states cannot get a bailout, by the federal government. It's not going to bail out the states. They're on their own and they can't declare bankruptcy. This will be interesting. Now, one thing, then the tale of two sinks, and I think this is my last slide. The recovery in the junk bond market, you can see that with the high yield CDX. It got out to about 900 basis points. Now stands about, it's gotten worse since in recent days. Now it's more like 700 basis points. But look at BB CMBX. Now we're picking on a really bad one here. This is the worst slice of CMBX, commercial mortgage-backed default index, because this one happens to be populated with lots and lots of second tier and third tier regional malls. And you can see how these spreads have blown out, not to 1,000 basis points, to 4,100 basis points, 41%, which obviously anticipates en masse defaults in this particular cohort. Notice how there's been no recovery. Actually, it started to recover a little bit today with that announcement of one Simon Mall company opening 49 different malls, trying to get the economies going in certain regions. But this just shows you how dysfunctional the capital markets have been made by the Federal Reserve. Because if you're in one sink, you get bailed out. If you're a high yield, if you're in the bailout sink, like the high yield CDX, well, you've had a nice recovery. If you're in the other sink that they're not protecting, you're out at 4,100 basis points. There are people in the commercial real estate industry, understandably, just screaming bloody murder, not so much about the picking winners and losers, although that's part of it. It's more the horrific state of the mall market, basically, which is what this thing represents. So Tim, that's what I have in terms of comments. I went a little long, but I kind of figured people don't have another meeting to go to so much as they would under normal times. So I've indulged a little bit extra, and I'd be happy to take some questions, and take it away, Tim.
Well, thanks, Jeffrey. Fascinating stuff, though not the most encouraging. Pretty daunting, the economic environment and maybe market environment that we have ahead of us. We've got 5 minutes left. Maybe we'll go a little bit longer than that with the questions. We do have a bunch. I'll try to combine two questions here for the first one. I think this summarizes a lot of it. The first, I think these two questions both relate to equity markets, but different time horizons. The first is about the emotion of the general public. This person is saying, at what point does the media outweigh fundamentals? I think this is in response to you suggesting on equities that we'll likely retest the lows. And this person says, everyone I know has said the market will rebound. I need to get in now. Do the flows offset that so much that we never retest the lows? And then I'll ask a second part to that. That's a shorter time horizon. that chart was fascinating to me because you had the two comparisons of the drawdowns were Japan and the NASDAQ. And I think looking past whether we retest the lows or not, the thing that I took out of that was the NASDAQ came back. We eventually, it was long, it was several years beyond what the chart showed, but eventually it bounced back and soared. Japan never did. Do you have a view on where we're going long term for equities and the economy in general? Just thinking about that.
Yeah, the comment that yes, suddenly the narrative has gone from, oh my God, this is the most dangerous stock market of my lifetime, to how can I get more aggressive? I saw a guy today on CNBC say this is the best time to buy the stock market so far this year, which just seems bizarre to me. I mean, you could have bought the Dow at 18,650. I mean, how is the Dow at 24,000 better? Because they say, well, you buy when it goes from really horrible to a little bit less horrible. But this is classic stuff. You got a huge flush. Everybody's terrified. The narrative is, oh, I've got to get out if I can just get a little bit of an opportunity. Like my brother, who swings a hammer for a living, but he's been a very frugal guy, and he actually has a real retirement nest egg, never having made a lot of money. But he was all panicking too. And then when the S&P was up at about 2875, I called him up and I said, "This is your chance. I mean, you want to pare back if you were feeling overly exposed." And it was really hard to convince him. I mean, here the market was up like 30%, but to his credit, he did sell half of his stock holdings, and I'm sure he's sleeping a little better. But no, I just think that this is classic. You go from a narrative of I've made a huge mistake and I'll never do it again, to oh my God, I've missed this great rally. There is no great rally. The S&P 500 was up near 3,400. It's at 2850 today. I mean, you got to put things in context. But flows have definitely reversed, but these are flows. My experience is pretty long. I've been through a lot of cycles and a lot of market crashes. And one of the patterns that's most typical is you get into one of these rebound rallies, and it really changes the psychology. That's what a bear market rally is basically lives to do, to restore the narrative that characterized the top. That narrative is never coming back. We are never going back to January 2020. I think my poster child for what I think is wrong with the present market psychology and why I'm negative short term, and I don't just think we're going to test the lows, I think we're going to substantially take them out. I mean, S&P 500 will not start with a 2 in its first digit. I think that the poster child for the out of kilter psychology in the market right now is the rebound in Starbucks stock price. Starbucks fell 50%. It fell all the way back down to where it was before its massive rally of the last few years. I think it fell all the way back down to January 2016 type of levels. That's big, that's because the consumer was just owning the economy. People were frivolous in their behavior. And so Starbucks got absolutely crushed on the shutdown. And now the Starbucks is way back up. It's way back up to kind of near, it's probably only down by about 20% now from its all-time high. Starbucks is like ground zero for behavioral changes. People will not be spending, $8 on some fancy latte thing anymore. One thing they've learned at stay at home is it's really easy to make your own coffee. And it actually tastes pretty good, when you make it yourself fresh like that. And I just don't think people will have the tolerance for that type of stuff. So I think Starbucks characterizes what's wrong with today's market psychology. Now that chart that I gave the verbal picture on, didn't have it in the deck of first Japan, then Europe, then emerging markets, and they never made it back. I don't think that the S&P 500 is going to make it back to its peak for the rest of my career. Now, I'm not 25 years old, but I also don't have just 5 years left in me. So I just think that we have a multiple year re-sculpting, and it's a good thing. It's painful as it's happening, but it's a really good thing that we get away from the I cut your hair, you cut my hair economy, and we call it growth. So that's kind of what I say to short term. I think you're going to see a big move down that, long term, it'll take many years to repair.
Well, maybe with that, one more question, and then we'll wrap up with some quick lightning round questions. I'd love to pivot to where you see opportunities right now, given that very challenging environment. How are you positioned, and then how should investors in diversified portfolios be positioned right
now? Well, in the bond market, I think there's a phrase that worked in the last month, but it's already exhausted, and that is traders should buy what the Fed is buying. That's no longer the case, because the Fed has artificially set prices at levels that don't make any sense. The prices of corporate bonds are higher than what you're really going to get when you go through the default cycle, particularly in the high yield bond market, where there's very large defaults. And the downgrades from the investment grade market are really going to cause a problem for the pricing dynamics. I think emerging markets for the time being should be avoided. I think the virus effect could be quite bad on emerging market economies, and they have very poor healthcare systems and just don't have the same wherewithal. So you kind of cross that one off. So what's sort of left? I mean, I don't really like the US stock market. I don't really like gold. So how I'm actually positioned personally is I am short stocks. I am long a few, but it's mostly healthcare stuff, which are highly speculative things. And then other than that, I am 50% cash in my portfolio, but normally buy stocks and gold and stuff like that. I'm 50% cash, 50% short the S&P 500, and I'm long about 15% of some of these lottery ticket stocks. In the fixed income side, you've got to be ready to buy the really, really hard to buy stuff. We're very carefully looking at single A, triple B, and then even in some cases, double B categories of consumer asset-backed securities oriented, commercial real estate. You have to be very careful with this stuff, because you have to put in loss-adjusted return analysis, and you're flying kind of blind here. We get some remittance reports every month, but we only have one so far, and it's kind of a partial. So the other problem with these things is we've got this, you don't have to pay your rent, you don't have to pay your mortgage for a little while problem, which has been somewhat clarified. It's looking a little bit safer in the non-guaranteed mortgage-backed securities market, where we were worried that the government was going to put these servicers out of business by forcing them to advance the forbearance. But there's been some clarity that's only going to be for 4 months, which most of the major servicers wouldn't have much problem with. So what we're really trying to do is stay liquid. Treasuries are not very attractive, that's for sure. They're not vehicles to make money, but they're probably a reasonable vehicle to just hang out. I mean, if hanging out at 30 basis points is palatable. And then you've got to look for some really big opportunities, but they have to come in the most scary sectors. The good thing about DoubleLine is we have tremendous experience in those sectors, and we've been through this type of a default cycle from the residential mortgage market, and we thrived, not only survived, but thrived. So I think we've got the right mindset. But 5 words that I use during crises, I came up with this back in, like, I don't even remember, it was certainly before, global financial crisis. I think it was long-term capital management blow up. It's from a Rolling Stones song. Time is on my side when it comes to this stuff. Time is on your side. You don't, this mentality, you got to go out there and grab stocks grab Starbucks, which is rebounded, you know, is rebounded 60%. No. You'll be able to buy Starbucks way lower again, and you'll be able to buy the CMBS and the ABS markets and some other parts of consumer finance, even airline debt, as scary as it looks. I mean, that's the stuff that where the risk reward actually makes sense, not in the bailout markets that have been rejiggered back to, you know, the world is going to fall back to January 2020 which I just don't believe.
Okay, well, a challenging picture there. Maybe we can wrap up with some fun and hopefully happier questions to take us home and leave everyone in a little bit better mood after that sobering picture. So Jeffrey, what is the thing you miss most while in lockdown?
What I missed the most was the Masters tournament wasn't on TV. The two great sporting events. I'm a big football fan, Buffalo Bills fan. They had a pretty nice draft. They're looking pretty good now. But the Super Bowl's #1 and the Masters is #2, and it's like a rite of spring. I mean, it's like I really miss it because there's something about the repetition of the azaleas and the golf course that you actually. I've never been there, but I almost know what the holes are like because you see it so many times. So I miss the Masters.
That's a great answer. Hopefully we get it in November. What's been a pleasant surprise while stuck at home?
How clean the air is in Los Angeles. There's so little traffic that the amount of smog is down like 80%, and the air is actually crisp and clean. And so that's been a really pleasant surprise.
That's great. I thought you might say early on in lockdown, Tom Brady leaving the Patriots with being a Buffalo fan.
Well, he's done. This doesn't matter.
What show, movie, or book have you enjoyed during this stretch and would recommend to everyone?
It's sort of timely in a certain sense, and it's also a classic, and it's a great book. Hard to read, and you kind of need a dictionary next to you, almost like reading Jim Grant's Interest Rate Observer. But it's called The Great Crash of 1929 by John Kenneth Galbraith. And it's very easy to read. You can get the gist of it. I think it's like 120 pages, and it's really fascinating. And it sort of shows you how the crash of 29 happened, which was quite different to how this one happened. But the human nature aspect of things is remarkable how little it changes.
Great. The thing that people are not talking about or worried about enough is blank.
How unhealthy the economy was even pre-virus. People are clinging to these two catchphrases as panaceas. Testing, 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 like that's the answer, which it just isn't. I mean, it's good. I mean, it's a good thing, but it's not a panacea. And reopen the economy, which I don't think people understand that phrase is extremely oversimplified, and there's all kinds of complications. What's going to happen to universities? What's going to happen to state colleges? What's going to happen to the restaurants that can't reopen because they can't get their employees back? And even if they could get their employees back, they can only have half of their tables or a third of their tables. The margins aren't good enough to be able to operate at that capacity. I saw an interview with the guy, the head of Waffle House today, and they asked him roughly what percentage of your restaurants have to be full for you to survive. And he didn't have a ready answer for that, but then he cuffed 50%. I think it's more like 75%. Will we get back to 75% restaurant? Maybe some will, because leading restaurant industry experts have opined that we could lose 75% of all restaurants, particularly, unfortunately, you might end up with your choice of restaurants is Chipotle, which I hate, Taco Bell, Burger King, right? All the ones that have the critical mass to survive. The mom and pop place, I just don't know how they can come back. So the health of the economy is really not being talked about enough. It's a panacea type of conversation.
Okay, and last one here. I know you've talked a lot about the shift in psychology as a prediction, but I'll ask anyway, see if there's anything different you want to offer. Do you have a prediction on a way our world will be permanently changed after this?
Yeah, absolutely. People are actually going to start saving money. I mean, it's unheard of to people that are, 25, 30 years old today. This concept of saving money. People will start saving money, and that is a great thing. But as it starts happening, it slows things way down, and so that's sort of the problem with it. So it will be a great thing, but we have to get from here to there. When I was a kid, and I mean a little kid, there were no credit cards. They didn't exist. When I was a kid, there was no car loans. You had to actually do this really quaint, naive, novel sort of thing. Save money before you buy stuff. And that's real savings, that's a real safety net, not government to the rescue with a fire truck. It's a really sound financial habits is what we need. And we'll be back to that because of this shock that put so much fear into people. So there is a silver lining. It's just that we've got to work through it before we get to that better place. Oh, by the way, on saving money, one of the funniest videos, and you check it, you can just Google it. It's Saturday Night Live, Steve Martin, Save Money. And it's this clip that they did in like 1992 or something, where this guy wrote a book called, like how to save money before you buy things or something like this. And he shows up in the kitchen of Steve Martin and some other Saturday Night Live cast member. And they're fretting over how they're sitting at the kitchen table fretting about how they can't pay their bills because they have so much debt. And he says, "You need my book. It's called, Save Money Before You Buy Stuff." And it's just so hilarious because Steve Martin just can't get the concept, and he does it so well. He goes, "And where are you supposed to get all this saved money to buy stuff?" It's really funny. It's worth watching.
That's great. Well, Jeffrey, we really appreciate your time, your insights. This has been fascinating to go through. We've got a challenging road ahead here, but appreciate the insights that you've given us today and the time, and look forward to partnering with you in the future. Hope everyone on the phone is staying healthy and safe, and look forward to connecting with everyone soon. Thanks again.
All right. Thanks for the opportunity. Be well.